you. But they're doing it because Ireland's tax rates are a lot lower. So the Pfizer could collect all of its debt in the United States and get write-offs and actually pay negative taxes or no taxes at all, and then put all the profits in the company that they own or that owns Pfizer in Ireland and pay a much lower tax rate, saving the owners billions and billions of dollars. And this is called inversion. Well, in this case, the IRS and the feds got involved and prevented this from happening. And now the question is, will Congress step up and actually do their fucking job? We need to find a way around this, and that can be from either A, making it illegal in general, and making laws that prevent this, or what I would like to have happen, and I know my listeners won't really like this, but I don't think corporations should pay taxes. I know that sounds like a very libertarian thing for me to say, but hang on for a second. Let me explain this. When a company has to pay taxes, there's a certain amount of profit that they want to, they expect to, they desire to, they dream of making. And if a good part of that has to go in taxes, what they do is they raise the cost to you. Just like the investment industry with anything else, everything else that you buy, whether it's a car or a pair of blue jeans, you pay all the costs. The end user always pays everything, just like taxes. You always pay for everything. But it creates an extra level of bureaucracy, of paperwork, of tax collecting. And unfortunately, it gives the corporations the impression that since they're paying taxes, they should have a voice in what the government does. So my solution is that the corporation pays absolutely no taxes, 0%. But if they move money out of the country, they get whacked upside the head with a huge tax burden. They can't do that. They make the money in the United States of America, and they make the money off the backs of the American citizens. The money must stay in the United States and be used in the United States to either create jobs or expand their business. Now, if they decide to pay wages, and hopefully higher wages for everybody, not just the few executives, everyone there then pays payroll taxes. If they decide to pay out dividends, then the dividends would get taxed at the same rates as your earned income. And I also think that capital gains, unlike what they are now, should be taxed at the same rate that earned income is. I don't think that people that happen to make money from money, which generally is our rich folks, should pay 15 or maybe 20%, while you working hard for your job to make six figures, if you're lucky, might have to pay 25, 28, maybe with state tax, even in the high 30s. And if you make even more money, close to 40%, while someone who's really, really bringing in the big bucks pays 20%. I don't like it. So, it's not just that companies don't pay taxes. You have to change the entire system. So as soon as the companies don't pay taxes, they also don't get a voice in government. They're not paying the bills. You are. The government is supposed to be by the people and for the people. So the people should just directly pay the taxes instead of through a corporation. The other thing is that if there is no corporate tax, there is now no reason whatsoever for these companies to go overseas where they're not paying corporate taxes anyway, at least not to the United States. They're paying other countries. So we're losing all the way around on this. But recently, President Obama had something to say about this tax inversion with Pfizer, and I've got a little clip here, and I'm going to see if I can get it to go.
So I am very pleased that the Treasury Department has taken new action to prevent more corporations from taking advantage of one of the most insidious tax loopholes out there and fleeing the country just to get out of paying their taxes. When companies exploit loopholes like this, it makes it harder to invest in the things that are going to keep America's economy going strong for future generations. It sticks the rest of us with the tab, and it makes hardworking Americans feel like the deck is stacked against them. In the news over the last couple of days, we've had another reminder in this big dump of data coming out of Panama that tax avoidance is a big global problem. It's not unique to other countries. because, frankly, there are folks here in America who are taking advantage of the same stuff. A lot of it's legal, but that's exactly the problem. It's not that they're breaking the laws, it's that the laws are so poorly designed that they allow people, if they've got enough lawyers and enough accountants, to wiggle out of responsibilities that ordinary citizens are having to abide by. While the Treasury Department actions will make it more difficult and less lucrative for companies to exploit this particular corporate inversions loophole, only Congress can close it for good. And only Congress can make sure that all the other loopholes that are being taken advantage of are closed.
So, like Mr. Obama, President Obama said, it's not that it's generally illegal. They're technically doing what is allowed by law. It's just not in everybody's best interest, and that's kind of where I try to do things. What is for the greater good of people? The purpose of the country, the purpose of the government is to make life better, I think, for everybody involved. So that's the little bit about inversion. The other topic for today, of course, I mentioned earlier in the show, is about index funds for bond funds. And I've talked several times about index funds for stocks. However, it appears that it's been a while since I've talked about index funds for bonds. So I wanted to make sure that everyone knew you can get bond index funds. You can do this at Vanguard. You can do it at Fidelity. You can do it at many different companies. Of course, you could buy your own individual bonds. It's not something I'm particularly into. And one of the things that is a concern right now with bonds is that U.S. interest rates are at historic lows. It was 0% for the overnight rate. Now it's 0.25%. It might go back to zero. I don't see that happening. It might go up. I could see that happening. I could see it going up slowly and gradually over the next year or two, depending on the economic data, which at this point looks pretty good. Not great, but pretty good. And they have to normalize the rates, and the overnight lending rate could go up a couple of points in a couple of years. If you are in a long-term bond, if you have a bond that's a 20-year bond and it pays you 4% a year, if 2 years from now I could buy a 20-year bond and get paid 6%, why would I buy your 4% bond? Why would anyone want to make $4,000 when they could make $6,000 every year? The only way you can sell that bond is by marking it down a considerable amount of money so that it becomes equivalent to the current 6% bond. So your bond and or your long-term bond fund, if they're high-quality bonds, could lose 15, 20, 30, even 40% if rates go up a couple of percentage points. So something to be aware about. I've talked about that before. Check your portfolio. And if you have bonds, you want to know how long they are, how long the term is. If you have a bond fund, you want to look for the number called duration. You should have a 5-letter symbol for every mutual fund that you're in. And again, one of the things we've talked about, if you can't figure out the symbol for what your investments are, there might be a problem there. But if you've got the 5-letter symbol, you just type it into the Google. And if it's a bond fund, you should be able to very easily find the duration number. If you cannot find it, you, of course, may contact me, Phil at PolarisFinancialPlanning.com. And right now, I'm trying to keep all of my clients' portfolios with a duration below 5. What that means, if your duration is 16 and interest rates go up 1 percentage point, you should expect to lose 16% of the value of that bond fund. If they go up 2, it, of course, won't be exactly 2 times 16, but it'll give you a reference point. It might not be 32. It might be 25 or 28%. There's some math involved, and we can go over that if you have questions. So in retirement or close to retirement, what you want to build is what I call the cushion. And maybe I can talk about that again a little more in the future as to how much you want there. But these safer investments can include something like a short-term, high-quality bond index fund. The interesting thing is that the index funds for bonds might actually be an even better deal than index funds for stocks. The reason is that stocks generally return about 10% per year on average in the long run. What happens next year, Could be almost anything. I have no idea. Bonds, especially shorter term and more conservative bonds, right now might pay 1.5% to 2%. If you get an index fund with an expense ratio of 0.1 or 0.2, it doesn't affect that very much. But if you get a bond fund with an expense ratio of 1.2 to 1.5, you've eliminated the vast majority of the income you're going to get. And the advisor that is helping you, and I have my little air quotes up since we're on radio, helping you, they're selling you something, they know they can't convince you to get a fund that makes 0.4 or 0.3%. So now they have to get a different type of bond or a different type of bond fund. And there's a whole laundry list of different ways you can do this. The first thing you can do is not get short term. You can get intermediate term or you can get long term. We talked about the risks of intermediate and longer term if rates go up. You can get different types of bonds, not just high quality corporate or government bonds. You can get something called Ginnie Maes, which have to deal with housing prices and home loans. And they're kind of a quasi-government backed bond, and they respond a little differently when rates go up because people generally aren't going to refinance their home if rates go up. So they pay a little higher rate, but they're not subject to the sensitivity of interest rate increases, at least not immediately. So that's, the effect is different. And this is where when you build a diversified portfolio, different parts of your investment react different ways when things change. Another thing you can do is an international bond fund. Again, Vanguard has an international bond fund, and it pays 5 or 6%. Now you're taking on a little more risk by definition because they're paying you 5 or 6%. Because no one borrows money at 5 or 6% if they can borrow it at 1 or 2%. So, but because they're international bonds, they're not subject to changes in the interest rates in the United States. They will be subject to global changes in interest rates, which are also quite low, but you're also making 5 or 6%, so maybe there's some trade-offs there. A word of caution: if you invest in, purchase, whatever, an international bond fund, you must be certain that it is adjusted against the U.S. dollar every single day. If it's not, what can happen is you make 6% in this international bond fund, but it just so happens during that same time period, the U.S. dollar became 20% stronger, so you lost 20% when the money has to come back to the United States. So your net gain is minus 14%. Yes, I know, net gain minus 14%. So what you're doing is you're playing a currency exchange rate. That's what your investment is. Currency exchange rates, in the long run, make no money. Sometimes they go up, sometimes they go down, but there's no consistent pattern. And just like with buying options, puts, calls, futures, all these different hybrid types of ways of investing, the net gain is zero, but you've induced volatility, a lot of volatility for a long-term gain of zero. So that international bond fund must be continually adjusted against the U.S. dollar with hedging techniques. And of course, that does add a little bit of cost, so you want them to be efficient. Another thing you can do with bonds is you can get a high-yield bond fund, also known as a junk bond fund. And these things aren't necessarily going to be a big part of your portfolio, in part because they can be very volatile. And if this is the part of your portfolio that's the cushion, the whole idea is that you want something safer. You want something that you know is going to be there. It creates a drag in your portfolio, but it's going to be there. So you don't want to get too carried away. Maybe 5 or 10 or 15% could be in high yield, also known as junk bonds. Now, the reason for this is they are volatile, but they react differently than really conservative and safe bonds, and they aren't particularly subject to changes in interest rate fluctuations like high-quality bonds are. And the reason is a lot of these bonds pay 8, 10, 12, 14, or 15% interest. The reason they pay these high interest is because there's a high risk. So never get confused that whenever you're getting a higher risk, a higher return, a higher interest payment on something, someone had to pay more to borrow that money. There's a reason they had to pay more. You can't forget that. It's a very important